Hi, I'm Calvin Rose, and welcome to Invest Smarter. If you like these videos, please hit like, subscribe, and the notification bell so you'll never miss another one of our upcoming videos.
Well, let's talk more macro, because one big reason that stocks have been volatile is because the bond market has been, well, a disaster. Rates up 50% in a matter of weeks. Bonds selling off all over the world. In fact, your next guest warns this might be the worst bond market of our lifetime, and it will matter to stocks. Jim Bianco runs Bianco Research, went on sort of a Twitter thread/rant, and I'm going to read one of them, Jim, and I mean that as a compliment. The story of this hiking cycle continues to be the utter disbelief the Fed will get very aggressive, even risk a recession. Yes, they will, says Jim Bianco, and their policy is creating carnage in the bond market and eventually losses in your portfolio.
In this video, we're going to talk about inverted yield curves. I'm sure you've been hearing this on the news lately. We're going to talk about what an inverted yield curve is and what it likely means or doesn't mean. I'm sure right after watching that CNBC segment that I just showed you, I probably scared the crap out of you. But let's talk realistically about how often an inverted yield curve really matters and makes a big difference. This could be one of those times, but it might not be also. What is an inverted yield curve anyway, and why does it matter? Well, let's take a look at a graph that will kind of demonstrate this. So what you're looking at here is the yield on U.S. government treasuries on the vertical axis, and on the horizontal axis, you're looking at the duration of the treasuries. So think of duration as how long you're giving the government a loan, right? If it's a 3-month loan, then that's a very short loan. If it's a 10-year loan or 20 or 12 months, that's a very long loan. And if it's certainly 30 years or 360 months, that's a very long loan. So the longer the loan, the higher the risk to you, the lender. And so if you think about it, as you go out further in duration, you want to get more return for your loan to the government because you're taking higher risk. So if we look at this blue curve, which is a normal yield curve, so if you look here at the very short end of the yield curve, we have a lower interest rate, 1%. And then as we go out in time, you'll notice the interest rate keeps rising because the loan is riskier, so we should get more return. Well, what happens when a yield curve inverts, and why does it invert? Well, let's take a look at that. So what typically happens is, and you'll hear a lot of talk about this on CNBC and other news stations, the Fed, the Federal Reserve, controls short-term interest rates. And if they feel they have been too lenient, too easy with the money, creating too much demand for purchasing goods and services by making money easy, then they'll start to increase those short-term rates to try and slow things down as inflation heats up. So how does inflation heat up? Well, if there's a lot of money in the economy, jobs are good, people feel good, the stock market's up, they go out and spend it. And that kind of demand increases the prices of goods and services, and that creates inflation. So how does the Federal Reserve combat that? Well, they start raising the short end, which is the only part they can control. They start raising those rates aggressively, and with the hope that that curtails demand, maybe even makes the stock market go down a little bit, which makes people feel less wealthy, and then there's less buying demand on goods and services, and that causes prices to moderate. So how does the yield curve invert, though? Why don't the longer rates go up? Well, the longer term rates, the 10-year, the 30-year bonds, those rates are determined by market demand, not by the Fed. So as the Fed cranks up short-term rates and the longer-term rates controlled by the market don't respond in kind, you end up with an inverted yield curve where the interest rate on the shorter treasuries is actually higher than on the longer treasuries. Now, the real question is this bad or is this not bad? Well, let's talk about it. Before we get into is an inverted yield curve good or bad, you can see from this graph published by the Federal Reserve that they are promulgating the idea that an inverted yield curve is bad. So what are we looking at here? This particular graph shows the difference between a 1-year Treasury rate and a 10-year rate. So you're basically looking at a short-term Treasury minus a long-term Treasury. So when the short-term Treasury has a higher yield than the longer-term Treasury, you can see those situations in red here where that difference goes positive. And of course, what we're seeing on this graph is the difference between those rates on this line in this axis. And then the gray bars are actual recessions that have happened in the past. And this is kind of funny because if you think about economic cycles, you have expansion, you have a peak in the economic cycle, you have contraction where the economy declines, and then you have a trough where it bottoms out and then starts over again. So you can see here before every single recession in gray, the yield curve has inverted. So, of course, this is a predictor of bad things to come. Well, it doesn't quite work that way, and it isn't. So why do I say that it doesn't work that way and it isn't necessarily a harbinger of bad things to come? Well, let's take a look at this a little bit differently. This is the similar chart. We're not looking at inverted yield curves here, though. The gray bars are still the recessions by date along the bottom here. The red line is the real gross domestic product, and the blue line is the unemployment rate. So what really matters to you or me when these recessions happen? Well, in my mind, what matters is, does employment get near or above 10%? You know, if unemployment's running 3, 4, 5%, the economy's in pretty good shape and people in general aren't hurting. But when it starts getting 10% or above, things are getting pretty rough, and it can really affect a lot of people. So let's look at this curve. We've got this going all the way back to 1950, and you can see here that before the quote recession in 1950, the gross domestic product started dropping, and unemployment rose and went up. And the same thing happened here in the mid 1950s and again in the late 1950s, where it happened a little bit worse there. So you can see the unemployment rate didn't get to 10%, but it got fairly high. But then you see in some of these other ones where, for example, 1970, where the unemployment rate went up, but I don't think it was much above 5%, if at all. Now you can see clearly in 1975, we had a big jump in unemployment rate. Back in the early 80s, when inflation was running rampant, the unemployment rate ramped up to over 10%. Not a good thing, but it wasn't really bad here in the 1990. Wasn't bad here actually in the early 2000s, even though there was a dot-com bubble bust back then. And then we get to the Great Recession in 2007, 2008. You can see here it jumped dramatically, went up to 10%, and then gradually declined. Now, more recently, during the pandemic, you can see it went straight up. In fact, we were running at about, it looks like, a 15% unemployment rate, which is unheard of. It never got to that level through all this history, but then it also came back fairly quickly. So if we add up all the times where the unemployment rate actually even approached 10%, there are 12 recessions depicted here, and only 5 of them ended up where unemployment reached even close to 10% or above 10%. So that's 41% of the time we actually had call it a bad recession when the yield curve became inverted. The other problem with this belief that an inverted yield curve is bad is that it can become a self-fulfilling prophecy. So in general, if people think an inverted yield curve means bad things are going to happen, well, think about the CEO of a big corporation who believes that, or a money manager who manages billions and billions or even trillions of dollars who believes that is a bad thing when the yield curve inverts. Well, if the CEO of the corporation stops hiring people or stops capital spending, or worse yet, starts laying people off in anticipation of this bad event, or the money manager starts taking money away from risk assets and putting it in safety assets, those actions by themselves, if enough people follow them, can make this a self-fulfilling prophecy. That's not a good thing. And then what's the follow-on if that happens? So the corporations stop hiring, stop spending money, the money managers start shifting their assets, and the general public sees their wealth go down because their investment accounts drop, so they stop spending money. And you can see how this snowballs into a really bad situation. So what's the bottom line in all of this? Look, yes, a yield curve has to invert sometime between the trough of an economic cycle and the peak of an economic cycle. Has to happen. It's going to happen. Does it mean really bad things are going to happen? No, not necessarily. In fact, less than half the time. Will this time be different? I don't know. I don't think anybody knows. Look, we had a major disruption to our lives and to the economy during the pandemic. There was a huge supply chain event where everybody went out and overstocked, bought things off the shelves. You remember those days when you went into the grocery store and certain shelves, a lot of the shelves were empty? I remember them. In fact, here's some pictures that I took when I went to the store during that time. Well, that huge shock to the supply chain caught everybody off guard, and it caused, huge problems with increasing prices and shortages. And guess what? The other thing that causes prices to go up are shortages. You can't get something, you're going to pay more for it. So we're still working through all of that disruption to supply chain and to manufacturing and to, having access to goods and services. So that's still working its way out. So, is this inflation transitory or not? Nobody really knows. But let's see where this goes. Certainly if everybody starts freaking out and they stop hiring and they sell their risk assets, this can become worse than it really needs to be. So let's really see how this plays out. I'm Calvin Rose, and thank you for watching Invest Smarter today. If you like this video, please hit the like, subscribe, and notification bell icons so you'll never miss one of our upcoming videos about investment topics. Thank you for watching today. That's all for now.